Hey, real estate investors, it's Randy Wolfe. Welcome back to the channel. Today's episode is all about the Federal Reserve's upcoming rate decision. It's a hot topic that could significantly impact your real estate portfolio. So, will the Fed lower interest rates or will they hold steady? And more importantly, what does this mean for you as a real estate investor? Let's dive into what's happening and what it means and how to plan for both scenarios. All right, so what's going on with interest rates? Let's sort of set the stage here. So according to a recent report by CNBC, Treasury yields move slightly lower as investors gear up for the Federal Reserve's meeting on July 29th and the 30th. The benchmark 10-year Treasury note yield, which heavily influences mortgage rates, was just a hair lower at 4.364%. Now, the 2-year yield also dropped slightly. But here's the kicker. Fed funds futures traders believe that there's a 97% chance the Fed will actually leave the rates unchanged. So why does that matter to you as a real estate investor? Well, because the Fed's interest rate decisions act like the steering wheel of the economy, and they influence everything from consumer spending to business investment. And yes, real estate prices and mortgage rates are significantly impacted by this. So understanding what the Fed's role is pretty important. And to fully understand the potential impact, let's break down what the Federal Reserve actually does, because it's kind of confusing to most people. So the Fed's main job is to control inflation, to maximize employment, and to maintain stable financial conditions. One of their key tools to do this, you guessed it, interest rates. When inflation is high, they raise rates to cool the economy. When growth slows or a recession looms, they lower the rates to stimulate spending. But in the current climate, inflation is relatively tame. And in fact, the Treasury Secretary recently questioned why the Fed isn't already lowering rates, saying the U.S. has seen very little, if any, inflation recently. So what gives? Well, the Fed may be cautiously trying to avoid igniting inflation again, or perhaps they're not fully convinced the economy is as soft as it looks. Regardless, real estate investors need to be prepared for both of the possibilities. So let's compare both scenarios so that you're ready. All right, scenario number one is the Fed lowers interest rates. All right, let's imagine that the Fed actually surprises the markets and cuts interest rates. Here's what could happen and what it potentially could mean to you. So the pros for real estate investors would be the following. Number one, the big one, is cheaper borrowing cost. Mortgage rates are closely tied to the Treasury yields and the Fed's interest rate policies. So lower rates means cheaper mortgages, especially for investors using leverage. That can lead to higher cash flow on rental properties, easier refinancing options, and increased affordability for first-time investors. Number two is rising property values. Lower rates are typically going to increase buyer demand. More demand equals higher home prices. If you already own property, this could be a huge win. And number three, stronger cap rates in some markets. As yields on bonds fall, real estate becomes a more attractive investment alternative, potentially boosting cap rates and valuation multiples. Now, like with anything, there are actually some cons to watch out for. Number one would be increased competition. Lower rates attract more buyers, both retail and institutional, so expect higher competition from good deals. Number two is risk of over leveraging. With easy access to cheap capital, it's very tempted to get overextended, but you need to be disciplined. Don't assume appreciation will cover bad underwriting. And number three, potential inflation down the line. If the rate cuts overheat the economy, inflation could rise again, eroding real returns and forcing the Fed to hike rates later, creating volatility. Now let's take a look at what's more likely, that the Fed's hold rates at the current target range of 4.25 to 4.5%. What this means for real estate. First off, stability for now. So keeping rates steady could bring a sense of predictability. Investors and lenders can make plans without fear of any sort of like sudden changes. Also, continued higher borrowing costs. However, you got to look at the mortgage rates will likely remain elevated, and that means higher monthly payments and lower cash flow unless you buy right. High rates typically dampen demand, which could slow price appreciation, or it could even cause corrections in some of the overheated markets. And if rates stay high, homeowners and developers sitting on inventory may become more negotiable, especially in markets with supply overhang. So that could end up increasing some motivation for sellers. Now let's talk data for just a quick sec. So while it's quite weak economically, key reports like existing and new home sales and jobless claims are actually dropping soon. These are crucial because they influence how the Fed thinks. A weaker jobs report, more likely rate cuts. Strong home sales, more likely the Fed stays put longer. As investors, we need to be watching not just rate cuts, but also mortgage application trends, rental vacancy rates, and inflation indicators like the CPI and the PCE. These tell us where the winds are blowing before the Fed ends up reacting to those things. So as a real estate investor, what should you do? That's the question. It's a great question, and here's your playbook regardless of what the Fed decides. If rates drop, which again is not quite likely, but it could happen, you want to lock in long-term financing at the lower rates. Consider value-add opportunities where capital is cheap, and be careful of bidding wars. Don't chase deals with poor fundamentals. If the more likely scenario happens and rates hold, focus on cash flowing assets with strong in-place rents. Negotiate harder. Sellers know the financing climate is pretty tight right now, and you can use that to your advantage. And look into creative financing like seller carrybacks or partnerships. I talk about that in another video I have on 7 ways you can fund real estate deals, but check that video out if you get a chance. But you just want to look into options that can help you with these rates being where they are. And again, creative financing is a great option. Look, none of us can predict the Fed with 100% certainty, but what we can do is stay informed and prepared. Whether rates fall or stay flat, opportunities exist for those who know how to play the game in the current conditions. Remember, real estate investing is not just about reacting, it's about strategizing. With the Fed's meeting just around the corner, actually, like I said earlier, it's July 29th through the 30th. Now is the time to watch the data and know your numbers and get your financing lined up. As always, I appreciate you watching this video, and if it helped clarify interest rate decisions and how they impact real estate investing, be sure to like, subscribe, and hit that notification bell. Let me know in the comments below, do you think the Fed should cut rates or hold, and how are you adjusting your investment strategy?